move on a bit to towards algorithmic trading platform architecture, as in how it works, as in what are the different components of algorithmic trading platform, and then we will try to run a simple strategy on algorithmic trading platform in the end. That will be followed by the Q&A session. So, all right. So algorithmic trading. So the question is that what exactly is algorithmic trading? So first, let's try to look at a more broader thing that is called electronic trading. So electronic trading, which became prevalent in 1980s, even before that in the developed markets. So that is sending orders over an electronic medium instead of calling a broker. So earlier it used to be more of a pick. In a lot of algorithmic trading, in a lot of exchanges, that is still the practice, like LME being one of the example, which is one of the global exchanges, London Mercantile Exchange. So the pit trading was taken up by electronic trading in 70s and 80s, and it became quite prevalent in 1980. So what is electronic trading? Electronic trading is simply sending orders over an electronic network instead of calling a broker. So there are various ways to connect to the exchange. Now even the internet medium is also quite popular among the retail players, but most of the professional prop trading firms or the hedge funds, they use dedicated point-to-point lease lines and all to connect. So that is about electronic trading. So which is a superset of algorithmic trading. Now algorithmic trading is a subset of electronic trading in which you are using algorithms to generate the signals and to generate the orders, and you are sending across your order to the exchange in automated fashion. So basically there is no human intervention when you are using algorithms. So you are replacing human interface to human interaction primarily towards building the strategy rather than executing the strategy. The execution is taken care of by the machine itself. Now within algorithmic trading, there is a further subset which is called high frequency trading. So a lot of people confuse algorithmic trading with high frequency trading. While the truth being that high frequency trading is definitely a part of algorithmic trading, but it's not what algorithmic trading means as such. So high frequency trading is a special category of algorithmic trading in which your holding period of a trade is very small. You keep on replacing and you keep on sending new and new orders all the time, and it's the basic characteristics would be like high order trade ratio, holding period of the trade holding period of ranging between milliseconds to seconds to maybe maximum few minutes, and you just bombard normally a lot of orders that you send. These kind of trading strategies, they are very sensitive to the latency. So what is latency? Just to give you a brief definition, latency is the time that your order is taking, or the time that is being spent while the data is traveling, be it the market data or be it your order that you're sending. So because you understand that you might have your server located in, say, New York, while you're trading on, say, in Chicago. So in that case, there is a huge distance which is there. So your data that you're receiving from a CME or the order that you're sending to CME, it has to travel that path. And there are physical limitations, like one such being speed of light, which has to be respected. So your data cannot be traveling more than speed of light. So there would be some milliseconds, some microseconds, or some milliseconds typically when we are traveling from one city to another. So which will be there. So that is latency. Now more closer to the exchange you are, the lower latency you will be seeing. So now, so the high frequency trading, since you are sending a lot of orders, you're replacing, you need to be the fastest. So it's a race to zero. So whoever is the fastest takes the cherry. Other the next few enjoys the cake, and the rest they don't have anything. So that's high frequency trading, which is quite sensitive to low latency. Next is quant trading, so which is related to algorithmic trading, but which is not exactly algorithmic trading, as in it's not a subset of algorithmic trading, or neither algorithmic trading being a subset of quant trading, but they are quite interrelated to each other. So in quant trading, what we do is that we use advanced statistics, econometrics, or mathematical or physics for creating different trading strategy models, and we use those models to generate signals, buy-sell signals, to operate our strategy. So that's quant trading. So that the name quant, that means quant is your maths using statistics for that. So it can be again low frequency, it can be high frequency. So you can even the guys who trade on fundamentals, they can be using quantitative models. So like you might be using factor models, which takes into account different say price to earning ratios or macroeconomic scenarios, macroeconomic data. So all those things are there. So it can be low frequency, but it is still using quant. So it'll be categorized into the category of quant trading. It can be high frequency as well, in which like a lot of market makers who do market making, who create market making modules using different statistical methodologies. Like you might look at order book or order book microstructure, market microstructure. So those things are there. Now, second part is the execution, mode of execution. So your mode of execution might be manual, it might be electronic. So, but typically when you're using quant for HFT trading strategies, since you say, for example, if you are a market maker in say certain option chain, so say you are sending orders in 10 different strikes, and you are market making using underlying, which is say a future or an index. So every time that index is changing considerably, you will be changing your quotes both at the bid and ask level. So that might mean if you are using tick by tick data, in that case you will be sending hundreds of orders every second, right? So which is not possible manually. So those kind of strategies you have to compulsorily, they need to be electronic. So so that's about the definition of algorithmic trading and related things. Second thing is that what is the right now the algorithmic trading. So I just include some few charts which are like which shows gives you an idea on where algorithmic trading currently stands. So you can see that this data is from 2006 till 2010. So so we see that this line graph. This is depicting the percentage of US equities volume that is done by HFT. So when I say HFT, it is definitely algorithmic trading, but it might not be including all of the algorithmic trading strategies. So so yeah, so it's so you can see that since till 2010, it was 54% of the overall US equities volume that was done by which were contributed by the HFT trading strategies. All right, so so you see that this is your on the left hand on the x-axis, on the y-axis, on the left hand side we have average daily volume shares in millions, so which has been rising considerably in the past few years. In the 2010 we saw a drop which can be attributed to a few of the changes which were there in the regulations, which came up in the regulations in primarily in US. Volcker rule is being also one of the reasons which is impacting a bit on algorithmic trading. But there were rules apart from that as well, which came up after the crash subprime crisis in 2010, 2009, 2010. So that's on the right, and this is basically you're seeing that 54% of the volumes in US equities, that's by HFT. All right. Next is, if you look at the different geographies, you will be able to see that in USA, you can see that it's more than 50%. In Europe, it's close to 38-40%. So in the developed markets, that is US and Europe, the contribution of HFT to the overall volume is quite high. That is followed by Japan, which is one of the most developed markets in Asia. And there also you can see 25-30% of the exchange volumes of the total volumes being done by HFT. I would again emphasize that these are HFT contributions. These are not algorithmic trading contributions. Algorithmic trading would be a bit higher than this. Now, if you look at this, these figures are from 2011, for which it were available officially. So if you look at the Asia ex Japan, it's not even 5%. So that is where the opportunity has been in the past couple of years, and it has now increased significantly. You can see that even in India, you have now, that's unofficial figure because we do not have the official numbers, for exchanges do not publish that, but nearly 20-30% of the overall volumes on the leading exchanges that comes. Now this is again why I was saying that it is further an opportunity. Is like you might be aware that in Europe there are talks of MiFID 2, MiFID 2, that is one of the regulatory one of the compliance regulations which are expected to come very near in the near future, which says that you need to have any order that is being sent to the exchange, it has to stay there for at least half a second. So, which is quite a stringent requirement with respect to the HFT trading. So you can expect that a lot of volume might flow to other exchanges which are not governed by those kind of regulations. But that is something that is expected, not yet happened. But yeah, it would not be fair to say that it will impact HFT heavily. But yeah, it will definitely have a small impact on the volume, definitely. So yeah. So that's about the algorithmic trading. And if you even see the hardware spending that has been done on the HFT trading strategies, you would be seeing that it has driven dramatically over the past 5 years. It has grown manifolds, and the overall expenditure by the HFT firms, it has already crossed $8 to $10 billion annually. So which goes into both infrastructure as well as your co-locations with the exchanges, better lines, better systems, low latency setting systems which are there. So yeah, so it's quite an exciting thing to be in. So if before moving to what are the skill sets which are required to algorithmic trading, I'll just share a small thing about the skill sets which are required for trading. So conventionally, the trading skill set has required more of understanding of the markets, more of having a good network, being up to date with the latest news, being aware of whatever is happening in the market, and more of analysis on a bit on the quant side as well as in technical analysis or fundamental analysis, whichever school of thought you belong to. So that was there. But with the advent of algorithmic trading, what has happened is there is a new pillar which has come into the picture, which is your technology. So technology both on the hardware and networking side, as well as on your software side, that is your programming side. So now technology plays a very huge role in the success of the organizations. So to be honest, to make money into trading, you might be aware of it already, that you need to have certain clear edges over others that you need. So it can be anything. It can be your technology, it can be your infrastructure, it can be your lower cost of credit, your human resources, your branding or your networking in the market, all of that. So now all the firms, all the big firms, if you look at, be it Citadel or be it Optiver, which are or Goldman, which are very active in algorithmic trading, you will see that they started with at least some of the edges, and gradually they moved towards a position in which they had all the edges among themselves, and that's what made Goldman make more than $100 million every day on Q2 of 2009, except for I think 3 or 4 days. So that's I'm talking about the algorithmic trading division. So definitely, if you have all these edges, then you would be able to make money in a much consistent manner while trading. So with the advent of algorithmic trading, there were two things. One is the quant, the understanding of quant, and the technology, which came into the picture. So if you are not really good in that will hamper your progress. So that's what we see over here, that for an algorithmic trader, so to be a successful one, you need to have good statistical understanding, you need to have good programming understanding, you need to have good understanding of the financial market, and obviously goes without saying that you need to be able to assess risk in a much better manner, because ultimately risk management is one of the key parameters in making money, because you might be making money 20 days out of 30, but if the remaining 2 trading days of the month, if you do not have the proper risk management in place, then you might lose all of it. So that is there. So that's what that was the idea. So like in India, we started in 2010 with this course, and Indian scenario was quite similar to what it was in the developed markets in 1980s. The regulator SEBI allowed algorithmic trading in 2008, which is quite recent, not even 5 years, and that changed the whole dynamics of the market. So you have there were a lot of jobbers who were not professionally very qualified, but they had the speed and they as in the manual speed, as well as their reading of the tape, which helped them in making a good amount of money initially in the year, especially during the bull run of 2005 till 2008. But after that, it came to a halt because the market changed, because algorithmic trading was allowed. So now that speed, the manual speed, which was one of the edges that was taken away by machines, because honestly, if you have very fast speed, still you would be able to send maybe one order in a second or maybe two, but that's all. So using machines, you can send hundreds or thousands of orders. It's more of limited by the exchanges, right? So exchange limits you to say 200 messages or 400 messages or whatever limits they put in. So that's how it changed it, and that's why we came up with this program that to provide these skill sets which were required into the market participants, so that they have the good understanding of stats and programming especially, and we also cover a bit on the quant trading part. So that takes us to the executive program in algorithmic trading. So the core content is divided into three parts, as I was mentioning. One is your statistics and econometrics. So statistics and econometrics is something that helps you in strategy ideation. It helps you in benchmarking. It helps you in backtesting. It helps you all through it. So I'll take a very simple example, which is one of my favorite examples as well, to convey how statistics becomes important into devising any trading strategy. So what you have is, say, for example, if I take a simple example of pair trading, say, be it gold and say euro, or say some index, say US dollar index, as well as NASDAQ index or NYSE, Dow Jones. Okay, so if I take that example, we see that there must be some correlation which is there between Dow Jones as well as the dollar index. So strength in dollar, it again varies from time to time. Sometimes when there is a flight to safety, it means that strong dollar means weaker markets. But when the flight to safety concern is not there, at that point of time you have strong dollar meaning more strong markets. So we see that there is some correlation in between Dow Jones and US dollar index. Now I want to create a strategy using that. So it's by my experience that I have seen them moving together. I'm seeing that in the chart, but I would like to now create a strategy based on that. So first thing to do before I start working on a strategy is that I need to establish my hypothesis. So I need to establish that what I'm thinking, what I'm seeing visually actually holds true. So for that, I can run some co-integration test in which I get to know that at 90% confidence interval, I'm seeing that both these things are correlated or co-integrated. So that justifies my hypothesis that okay, what I'm thinking is correct. Now next step would be I would like to create a tradable index. So I'm taking these two asset classes. Now either I can take the difference, or I can take a ratio of the two. We'll normally prefer ratio, so because it gives the returns kind of thing. So once you have the ratio, you take the ratio. Now you would like to do certain operations, because dollar index, that's a currency. Dow Jones, that's equity. They will have a very different volatility structure. They will have a very different levels of volatility as well. So you'd like to correct that thing, right? So for correcting that, you would again apply certain statistical tools which would help you in balancing that ratio, and then you try to create to bring it closer to something which is mean reverting. So something which revolves around its mean or revolves around a certain value. So you first to create that. Now that is something that is a tradable index. So you can say that okay, whenever this index is going 2.5 standard deviation above the moving average, I would like to sell this index. That is the ratio. Or wherever it is coming 2.5 or 3 standard deviation below the mean, I would like to buy this pair. So that's a typical example of statistical arbitrage strategy. So once I have done that, I would like to then backtest it. So again, I would like to know there are certain parameters like how many standard deviation away I should be buying from, whether I should be scaling up my position when it goes against me, or I should be scaling up when it is going in favor of me. There would be a lot of different parameters. So all these parameters, what I'll be doing is that I'll be testing them out with using different strategy parameters, and that would help me in creating something at least which was giving returns historically. Now, obviously, that doesn't mean that it will give you the returns in the future as well. This is not a sure thing, but it definitely improves your odds of making money of that strategy. So that's the process in which we are trying to first approve the strategy idea, the strategy ideation. Next thing is helping in benchmarking, in backtesting, into creating a model, right? So all of those things, we are using statistics there. Now, while we were using all these statistics, there was a lot of we will need a lot of financial computing tools. So at QuantInsti, we have a very strong preference towards using open source things. So we use R, which is R software, which is pretty decent and be heavily used globally by different hedge funds for statistical analysis. So that forms a part of the financial computing technology, where we cover different statistical tools, how to use them, and we cover Java primarily, and we're using that programming language for coding in on the algorithmic trading platforms. So that's there, and then there are different kind of strategies which we cover. So that's more of covering the strategy paradigms, different strategy paradigms. So be it pairs trading, be it options market making, be it market making, artificial intelligence based trading strategies, all of that. So there we'll go through them in details now. So the first part, statistics and econometrics. So we have 3 modules within that. So that's basic statistics, advanced statistics, time series analysis. In basic statistics, we go through probability and distribution. So there are different probability models that we go through and how. So it's more of a practical oriented course. So what we try to do is that we try to see how instead of going through different models, which we do, but still not going into that much of depth in theoretically, but more of practically. So how that would be applicable in while you're building up, creating your trading strategies. So that's probability and distribution, statistical inference, how to put them into when you're going through the backtesting models and all. Linear regression. So that's the basic statistics, just to have the basic understanding key concept of the key concepts. Then comes the advanced statistics, which is more applicable when you are going through the different trading strategies. So which is like co-integration. So like for the strategy that we were just discussing, that would be having a so the first step was to establish the hypothesis. So that you use co-integration for doing that. Then ARIMA arch-cart models, which is quite crucial in estimating the volatility, right? So we were trying to use volatility in that model as well, but it is typically more applicable on the option side. So when you are trying to forecast volatility for option pricing models. Then multiple regression, when you are going through different asset classes or different stocks within the same sector or different sector, you would like to run the regression, and based on regression parameters, you would like to create a model based on that. And then we also cover on the time series analysis, in which we go through stochastic math, causality, forecasting. So all of those things are included in the statistics part. Now, when you look at causality, now that is something that helps you not in just the strategy ideation and strategy modeling part, but also when you are actually implementing the strategy. So like if I go back to the strategy example that we're taking, so say you were trading between dollar index and Dow Jones average future, Dow Jones DJI futures. So in that case, what will happen is that if you're doing high frequency trading or even medium frequency trading, your profit margins are quite thin. They are not that much, but typically what you try to do is that you like to have your try to do a lot of trades with thin margin, but more assurity of getting to the profit levels. And for that, it becomes very important that you are not really paying bid-ask spread all the time, because bid-ask spread forms a good enough component of the overall profit that you're making. So what you would like to do is that you would like to quote in one of the legs and cover whenever you are getting the leg. That can be one of the ways. There are other ways as well, but sticking to this right now. So you would like to quote in one of the legs, and whenever you are receiving the fill on one leg, you would like to send a cover letter on or cover order on the other leg. Now the crucial question is, on which leg should I be sending my order? So for that, the first idea would be that, okay, whichever is wider, I would like to quote in that, so that my chances of slippage, that is the intended execution versus the actual execution, the difference between the two. So my slippage is not that much. Okay, that's fine, but I'm seeing that both Dow Jones future and dollar index futures, they are both quite liquid. For example, I'm just assuming. So in case that is there, then comes the next thing, that how do I decide in which leg I want to quote? So okay, so that is where again the statistics comes to your help. That okay, there are two things. I would assume that one of them is leading and one of them might be lagging, right? There are different reasons for that, but anyways, just now focusing on the statistical part. So I would like to have to find out which one is the leading one among the two legs. I would run a causality test. So which one is causing the movement in the other one? So I can go through different causality tests, Grange causality being one. That okay, I run that Grange causality test and see that at 85% confidence interval, I am seeing that dollar index is the one which is causing the movement in Dow Jones futures. That's brilliant. Now the idea is that if I know which one is leading, I would like to quote in that, and whenever I'm receiving the fill, I'll be sending the cover order on the other leg, and my probability of me receiving the slippage would be quite lower if I instead of if I do vice versa, because I'm quoting in the leading leg. So again, that is where you are using statistics again, and this is the implementation stage where you use it. So that is there. Now, second part is your financial computing and technology. So this again has three parts. One is programming, which is in which there is a Java primer for those who do not have much exposure to the programming earlier. So it's quite critical for them. We go through the introduction to the programming language, and then we use that understanding. We use that understanding to go through the different to code in the algorithmic trading platform. So that's on the programming part. Then is the technology for algorithmic trading. Now, in the technology, we primarily cover the hardware and the network infrastructure, as in the system architecture. We'll also try to take a sneak peek of what kind of system architecture is applicable for algorithmic trading. So, sorry, just a sec. Yeah. So that we'll go through in a brief right now as well. And then how to handle the HFT data, because HFT data, you cannot use the conventional tools, say Excel or the tools with lower computational power, because the data is huge. It runs into GBs, and for a single day data, you might have millions of rows, as in the millions of data points. So you need to have something which is way better than your conventional tool. R does the purpose for most of the cases. If not that, then there are advanced analytical tools which you can use. Then the statistical tools, which is Excel and VBA. We start with Excel because that is what most of the people are familiar with, but we very quickly end with that as well, because that is not the thing that you'll be using in practical. If you're specifically if you're doing it for HFT, then that's when we quickly move towards financial modeling using R, and then we use R for R and Excel for backtesting. And okay, then the third part is your Algo and Quant trading part, which is definitely one of the bigger ones. So in which we go through different trading strategies. You have the conventional trading strategies in which we do the startup market making strategies. In market making, we cover both the zero intelligence market making strategies as well as the dependent variable market making strategies, and execution strategies, which are quite relevant for people who come from the institutional broker kind of background. So that's there. Forecasting and artificial intelligence based strategies. So in these kind of strategies, you try to predict a small range for a very short term. So say for 0.1 to 0.2%, the range of 0.1% for trading in say next 20 seconds or next 50 seconds. So that's there. And then machine readable news based strategies, we touch a glimpse, we show a glimpse of that, because now you have so like a lot of people, a lot of funds who trade based on news, whatever news flow is there. So now there are systems which can do that for you. So you need not read the news and you need not look at the data yourself. The system looks into that and takes action as per the logic that you have given it earlier. So there are two parts to it. There is one part is your machine readable economic data, in which say your NFP data, inflation data, any data whichever is coming. There is some expectation. There was this thing called the previous data which came in. So like say for NFP, the expectation is 100K. Your previous data was say minus 50K, and actual thing is say 200K. So you can have it coded in advance that okay, if NFP comes in this range, I would like to do this, and then this. Or if it comes in the range much below the expected one, then I would like to do these things. I would like to first buy and then sell and do whatever you want to do. So that's machine readable economic data. Another part is machine readable economic news. Machine readable news. So in which there are articles which are being shown. So say when Bernanke is addressing the nation and on economic scenario in the country, and he's saying that he's using certain words that the economy is going through a tough phase and we are about to take strict measures for it. So it goes to the tone of your machine goes to the tone of the article and looks for certain phrases and certain keywords, and rates it on a scale of 0 to 100 that okay, it looks like a score of 80, which means it is very bullish. It looks like a score of 20, which means it's very bearish. So you can have that rating. So there are different NLP based analytical tools which do this thing for you. You can also develop your own, but that definitely demands a high level understanding of NLP as well as coding. So NLP is natural language processing. How is that important? Because English being a crazy language, you have you can be using the same word for two different things, so, for very opposite things. So like awful can be used awfully good or awfully bad. So it will have very different interpretations in the article. So that's where the natural language processing comes to the picture. Then you have the trend following strategy, mostly technical based, and that's for the basic trading strategies part, basic trading and startup kind of strategies. Then you have derivatives and market microstructure, in which we go through that okay, these are the different option pricing models. So you can apply algorithmic trading models for different asset classes. So when you're creating model, it does not really know and it does not really care whether it is the data for gold, or is it the data for the equity index, or is it the data for some option or whatever. So if you're applying it across different asset classes, you need to know that what kind of pricing models work for different asset classes. If you're using black shoes for say when you're trading FX, you might be in for a shock, right? Because the volatility smile, the volatility curve, they are very different for when you cross asset classes. Then the time structure for volatility. So how does volatility look as you go move ahead from right now to time T? Then dispersion trading, which is trading between the implied correlation, that is between your equity or your options vis-a-vis the index options, as an index option vis-a-vis stock options, which compromise that index. Then you have volatility forecasting interpretation, that is where you use arch and Karch actively. Manage risk using Greeks. So you use Greeks, that is like delta, gamma, rho, all those Greeks you use for creating trading strategies as well as for managing the risk, because delta is something which is giving you, it classifies your risk, right? So delta is positional risk. My vega is my volatility risk. So things like that. Then position analysis, order book dynamics, and again there are certain strategies in which what you do is that you analyze the complete order book which is there in the market and see what has been the historically how it has behaved and how it is different right now, and you can try to extrapolate that these are the events that might be happening right now, and you take your position accordingly. So that's there. And then you have desk operations, in which you go through the hardware and network as we were discussing earlier, which we also cover a bit in the technology part and bit in the desk operation. So this is more of telling you that what are the different network or connectivity modules in which you can connect to different exchanges, what are the different languages that exchanges offers you. So this is from that perspective. Regulatory framework, which all exchanges you can access when you are in a certain geography, say from India, what are the exchanges you can trade into. If you want to trade using algorithmic trading, what are the prerequisites for that? And if you want to apply it to the exchange, then what is the process like? All those things are there. And then exchange infrastructure and financial planning. So that's if the say exchange offers you co-location, that is putting a server into the exchange to have a low latency access to the exchange. Then how to go about that? Why is it important? For which kind of strategies it is crucial to have co-location, things like that. And then handling risk management in automated systems. So that's again is covered both in derivatives and market microstructure as well as desk operations. So it's a mix. Because risk management in algorithmic trading, in automated trading, is slightly different from the risk management in conventional trading desk. Because in the conventional trading desk, you have the benefit of human common sense. So if my data line is broken and there is no data flowing into my system, if I am sitting here, I would most likelihood I would not be sending any order because I am seeing that data is zero, data is not changing. But a machine would not know that. You need to tell the machine that, okay, please keep on checking that if the data is changing. You need to tell it that, okay, please keep on checking the socket connection that and connect to the socket and see if you are failing to connect to the socket. That means that data line is broken. So all those things needs to be taken care of. So we try to cover it from that perspective. So that's about the course content as such, and this is about the course mapping. So different modules. So this is introduction, in which we are doing the strategy, backtesting, the statistics module. This is your programming module. These are all the trading strategies kind of thing, which we were looking at it, and we try to see that how interconnected they are. So this is what this slide shows, that statistics, this is being used for creating these kind of strategies. Then these things for backtesting and the programming, this is being used for performance evaluation, portfolio management, things like that. So that is there. Apart from that, we also have a project work which which creates the course more dynamic in nature, in terms of it gives you the flexibility to choose what your project work you would like to do on. It has to be something related to algorithmic trading, but you can choose any topic under the roof of algorithmic trading. If you're not very sure, then we also counsel you on that, and we provide you that, okay, these are the topics that you might want to consider, and this is or otherwise you can just pick a topic of your own. So that creates more of a specialization kind of thing, that would be your specialization module. So it can be anything between trading strategies, options, financial analysis, anything like that. That is it. It's compulsory, and it lasts for about 2.5 to 3 months. So we start about 1.5 months after we start the course, the project course starts. So that's about the course mapping. And program deliveries, primarily it's targeted towards working professionals. So it's on Saturdays and Sundays, 3-hour session every day. It's a 4-month long program, and approximately 100 contact hours. Most of the classes are practical in nature, so it's a hands-on. It's primarily online. So primarily, as in most of the participants who attended, they do it online, because the participants come from different geographies across the globe. So we try to make the online medium as convenient as possible to the participants. This being a lot of participants who have connected right now, so we cannot have this session very interactive. But in the course, we ensure that we have small batch sizes, so that the interaction is there via online media. Then most of the things that we use, they are open source, not just for the analysis, but also the algorithmic trading platforms. We use the open source platform so that you can actually download it on your own system and trade as in learn using it. And both the physical as well as the online classroom, they are totally integrated. Whatever is being covered with the classroom students, that is what is being covered or attended by your online participants. And then we have a student portal on which you have all the course material and schedules and papers and supplementary readings. Everything is provided there in addition to the books that are given to you when you enroll. Okay, so enough about the course. Now back to the algorithmic trading. So algorithmic trading platform. So this is just to give you a brief idea about how it looks like. So there are three primary parts to any algorithmic trading platform. They are market data adapter, CEP engine, and order routing. Let me tell you what it is. So market data adapter is something that, say, if you are getting data from some exchange, say from NSE in India, you are getting the data. The exchange will be sending you data in its own format. So you need to convert that into something that your machine understands, your algorithmic trading platform understands. So that's what we call a market data adapter. So it's an adapter which is converting the exchange data into a format that your system, your algorithmic trading machine can understand. Next is, this data is being used by your strategy. So your strategy lies in the CEP engine, that is your complex event processing engine. So where all the calculations happen. So your, say if you're using a simple moving average crossover strategy. So to create a moving average, if you're looking at the moving average of Google or any stock for that matter, you will be asking the data server that, okay, please send me the latest data for this thing. You would calculate the moving averages, and you will see that whether the moving average, the smaller moving average has crossed the longer moving average. If it did, in that case, you are sending the order to the order routing system. So till the time you prepare and send the order, all of those things are happening in your CEP engine. So that's the brain of the machine. That's the brain of the platform. Next thing is your order routing system, in which the order that is being received, the order parameters that are being received by the CEP to the order routing system, it is again converted into a language that exchange understands, right? So first, in the market data adapter, you convert the data from the exchange language to a language that you understand. And when you're sending order out to the exchange, then you're again converting it from the format that your machine understands to something with what the exchange understands. Most of the exchanges have are FIX compliant. FIX is Financial Information Exchange, in which it's a global standard for connecting the methodology to connect to the exchange. So if it is FIX compliant, then it becomes very easy for you to connect to. Once you connect to one exchange which is FIX compliant, you can connect to multiple exchanges after that. So that's a brief of an algorithmic trading platform. Now this is system architecture, as in what we were discussing just now. So this is your application, your server, and your exchange. So in this is your premises, your own premises, in which your server is there, or on the exchange premises, but again the co-location, which is again your premises kind of. So you have market data, you have complex event processing engine, you have RMS. So this is how it moves typically. So you might be storing the data, you might want to replay, you might be sending orders to the simulator when you're testing the strategy, or you might be sending it to the exchange. So all of these things you have over here, and then you are also connect to the back office. You also, over here is the application. So application is something which is just used for sending the parameters in algorithmic trading. It's just used for setting the strategy parameters and viewing what is happening to your strategy. Otherwise, everything is happening in the backend on the server, which in most cases is located in the exchange itself, not in your physical proximity, but you remote connect to it. So yeah. So that's about algorithmic trading. Now, what we'll do is that we'll quickly go through an algorithmic trading. I'll just show you how it actually looks. This is one of the open source platforms. I'll just minimize everything for this. Sorry. Okay. So I'm looking at the strategy view over here, in which I'm seeing that okay, this is my strategy, which is there. I'm showing you pairs trading, which is in Java. Sorry, yeah. And these are the sample strategies which I have over here. I've already deployed them. So this is my strategy engine. So this is kind of a CEP. So this whole thing is actually CEP. I have multiple processes which are running right now over here. So this is where my database, I'm connecting to the database and the simulator, and this is the strategy agent. So here all the logs which are coming, it comes. So this is where I can code my strategy, I save it, and then I can export it. And then if I start the strategy, I've set the properties already. Say for Amazon, I've taken the Amazon and Apple as examples. By driver, I've defined in the strategy. I'll show you as well that the driver is a stock in which I'm quoting. I'm sending the quote. I'm sending the order to quote, and when I'm getting the fill on that, when that order is getting executed, I'm covering on this leg. So that is the leg 2. So this is leg 1. This is leg 2. There is buy threshold, as in the difference at which I want to buy of the ratio or difference, and order size is 2, and sell threshold is +1. So these properties are already there. Now I'll just show you that these parameters, which I was saying, that you can see that over here it is there, the driver, and these five parameters I am asking it that okay, this is driver, leg, buy threshold, sell threshold, and order size. So these are the 5 parameters that I have already placed into them. So over here, right? I can add more if I want to, but I only have 5 parameters for this strategy. Okay, so if I say start, I will start seeing that console. I'm seeing that this is the market data that is coming. This is coming fancy to a dummy market server right now. So some price it is coming, and if I look at go to the equity view, now I see that all these orders are being sent. So like it's sending in free flow. I'm sending to the simulators. I have not placed any checks just for the demo purposes. So you can see that all these orders are being sent and being replaced very, very frequently, right? When anything goes, when anything gets executed, I will get my my positions over here. So this is my equity view. You can also define your own views over here. This is my options view if it is an option that is I'm trading, and this is a strategy view in which if I'm when I'm coding, I would like to keep this view on. All right, so that's about it. That's how a typical algorithmic trading platform looks like. Just to show you an idea, I'll just stop this thing, so it will just stop and cancel all the orders. All right. So okay. Now I'll just quickly go through the things which are also there. So like one thing is there's a value addition course. So yes, Nishant, I'll just take the questions in a few minutes now. So going beyond the curriculum, what do we mean by that is that even after you complete the course, while you are doing the course, there's a complete faculty supervision that helps you in, especially when you are doing the project, that is your specialization. You are based on your choice of the project, you are assigned the relevant domain expert, and they supervise you all through the course, all through the project. Then even after the course and during the course, we provide placement assistance to the both participants as well as the alumni. So there are all the different kind of opportunities that keep on coming into across different geographies as well as the different locations for different profiles. So we provide on that, including the mock interviews, references, and all. And then we also have a forum which is not yet populated, but it is there, and we are planning to populate it soon. So that it becomes a very active ground for discussion between the participants, alumni, and faculty. So because we have now hundreds of alumni who are working in this particular domain in algorithmic trading, and it's a niche industry to be in. So knowing people that definitely bring different synergies, and we want this forum to be a common place for all our alumni and participants and future participants. So that is there. These are the important dates which are important for the coming batch. So today is the webinar. 17th is the last date for early bird registration. 6th of April, last date for registration, and 13th April, that is when the classes commence for the next batch.